Cool. All right, so I'm just starting the recording. What's up, everybody? For those that are, rewatching. So what we're gonna do today is go over inside bars. I'm gonna try to start from somebody who doesn't even know what an inside bar is, and hopefully by the end of it, you'll have enough to where you'll be like, all right, I could spot it. I know what indicator to use, and you could even probably start looking for a trade tonight to try out for tomorrow, right? So, cool. Everybody can hear me. Everybody. So, guys, for those that just joined, we're going to use the Any Questions tab. So, for those that are here that are not, that don't have their hands full, please put a thumbs up in the Any Questions tab so I know you guys know where to find it. Put a thumbs up if you know how to use the Any Questions channel. You see the little question mark emoji? Yeah, throw a thumbs up. I want to see who's alive. I want to see who's here, who's taking notes, who's gonna benefit from this. Because this is all free. I'm doing this for free, right? So, a lot of people would charge you, or they won't even tell you, and they'll just rely on you to pay them to give you call outs all the time. Have you guys heard of those people? They never tell you the secrets or anything. They just go into this, go into that, go into this, go into that. And sometimes you win and sometimes you lose, and all of a sudden, you don't know, it's been a month and the only thing you've realized is now you rely on this person to make you money. It's not a very confident way to trade. I'm going to teach you guys today one way to eliminate that. Now you're going to be able to find your own plays. I'm going to give you the watch list. You're going to be able to scan for your own plays and things to look for. You're going to be able to know what strike you're going to pick. You're going to know where to take profit and where your stop losses should be when you're starting. And I want you guys to do at least 50 to 100 of these trades. And I want you to document the ones you lost at and try to figure out why you lost. You could document the things you did well on the ones you did well. And I promise you, within 20 to 30 trades in, you're going to be a lot better than most of these traders. Most of these traders don't do this. They don't journal. They don't know when to take profit. It's just a way of gambling, right? So, cool. Everybody's in here popping them thumbs up. Let's go. Cool. So, I'm going to start with, I'm going to give you a link for the indicator, right? And the indicator, what it does is, this is how it looks, how the chart looks without the indicator. Just looks like you see the red candles, you see the green candles, and that's it, right? Now, when you turn on the indicator, what it'll do is it will ignore the little green, Bollinger Band that's going. But what it does is, you see how it lights up and it says IB and it darkens and says OB? Well, what this indicator does is it makes it easy for you to spot inside bars. Could you spot inside bars here? And I'll get to what an inside bar is so you can see, but what it will do is it'll light them up, so it makes it a lot easier for you to see them immediately. Boom, right there, inside bar, boom, right there, outside bar, boom, right there, right there. It makes it a lot quicker to be able to spot them. It saves you time, because if you look at this and then you take it off, you're like, is it an inside bar? Is it inside the previous bar? I can't really tell. Well, this thing will light it up. So we'll put that in the link. Is this the main strategy I use? Pretty much. It's the one that's the quickest way to do it, the easiest way to do it. Obviously, I've been trading for a while, so I can kind of mix in a lot of other things, like with this trade that I put in chart ideas. I've been noticing that this thing has been going on a downtrend. This is an optimal risk to reward, because you see how it keeps bouncing off of here. So, for me, I can kind of add it within it, right? So like right here, this was an inside bar play that I'll show you guys on this same thing. But what I'm going to do is, for you guys that don't know how to do it, and maybe for those of you that have did it but don't really know the full extent to it, I'm going to try to just get to all that, okay? So to start, you have to know there's 3 different types of candles, right? And I did this on the chart. I just wrote this up last night, so I hope you guys appreciate it. So there's 3 types of bars or candles, right? There's a continuation bar, right? It breaks only one side of the previous candle. You see how this only goes here? It doesn't go above it too. It continues the trend. That's why they call it a continuation bar. This is a bearish continuation. This is a bullish continuation. right? That's what you have to understand from here. And this will, like I said, this will all be recorded, so you'll be able to rewatch this, right? This is an outside bar. So after seeing a bunch of these, every once in a while, you'll see one of these. An outside bar breaks both sides of the previous candle. That means it goes above, the price goes above and below the high and the low of the previous candle. Now this can be a bullish outside bar if it goes below and then closes up top, or it could be a bearish outside bar where it goes up and then closes below. Now this is the moneymaker right here, the inside bar, right? So the inside bar doesn't break either. It doesn't break either side. It is whenever you hear like, oh, it was choppy, price wasn't moving anywhere, like the SPY today. SPY was an inside bar today. I'll show you guys real quick. Look, inside bar today. So you guys might even be able to play the inside bar tomorrow of the SPY. So you see how this candle and the wick, or some people call it the shadow, I like to call it the wick. See how the wick is far above it and it's almost shadowing. So the day before, the price went from 462 all the way up to 467. That means there's a lot of calls being placed, a lot of puts being placed, a lot of people buying in, a lot of people selling. There's a lot of movement, right? It's $5 whole of action upwards and downwards. And then all of a sudden today, everything slowed down. The price compressed. See how right here, I'm spamming the chat. So you see how here I kind of give the arrows. So this, a bearish trend, bullish trend, the price expands, right, from the day before to the day after on the outside bar, but it compresses. Now let's, use like what's a good, Izzy used a spring analogy. I like the spring analogy. So think of this day, it's a spring, big spring. And then all of a sudden, the next day, the spring compresses. Right? Now, ugly spring, but you get it. So what happens when you hold that spring together like that? That means the next day, whatever side lets go typically will have a relatively big reaction. If you let go of the top side, we might see a move up here, pretty strong move up here. Right? If the downside, you get a strong move down here. So does this always happen? Does that mean that every inside bar is going to cause a giant reaction up and a giant reaction down? No. But what I'm going to do is I'm going to show you guys the reason why the inside bar is really powerful. So you see every inside bar. Is this only on daily time frame? So for me, I prefer only use daily. You could use up to any day, so like 2-day, 3-day, 4-day, up to the weekly, 2-week, 3-week, monthly. Those are the time frames that are good because that's a lot of time to compress. You see here, if you go to the 5-minute candle, or you go to the 5-minute time frame, and you find an inside bar, this has only been compressing for 5 minutes. So it's not that hard of a compression. So the reaction, some people do play these, but I prefer to play a whole day of compression, especially when you're trying to play an option. Because options, you're usually playing the next day. So you want a whole day of compression so you could play, a day of reaction. So the time frames that I like are daily minimum. I don't like to play 4 hours. I like to do daily, and what it also does is at the end of the day, like today, this is when you start doing your search for inside bars. So when things compress, have you guys ever seen people draw triangles and they're always like the price is tightening, or they see, oh, there's a pennant and there's going to be a breakout? You kind of want to look at inside bars as price compressing. Now, this does a couple things, right? I'm going to tell you guys why it's so powerful. It has an objective preconditions and identification. Bunch of big words, blah, blah, blah. Simply put, objective meaning you don't have to wonder if it's an inside bar or not. It either is an inside bar or it isn't. You don't have to ask somebody, does this look like an inside bar? The price either broke the high or low of the day or it didn't, right? And with the it gives a precondition, meaning if you're only going to trade inside bars, you can do away with everything else in the market. It gets all that noise out. Have you guys ever seen people going, oh, I'm in this play and I'm in this play and I'm in this play, and you're wondering, well, dang, how do I find the one that works for me? There's so many choices. Well, inside bars have now limited you to a good amount, typically, anywhere from 10 to 5 a day that you'll see pop up, and you will only typically play those until you learn how to get better at trading. So the live streams that me and my friend Izzy are going to start doing, we're going to start building on these. But I wanted a lot of you guys to get the foundation, so that when I say, hey, there's an inside bar, you're not going to be like, what is that? Or you can actually engage in the conversation in the general chat, and you can be like, hey, I think this inside bar is good because of this reason, or, whatever it is, you guys can exchange ideas, right? So the second part is it sets clear and easy to follow triggers for entry and exits for beginners when coupled with the fib. We'll get to the fib. So I'm going to show you how you should be playing the inside bar. So now you know how to identify an inside bar, and the indicator will show you. It will show you IB like that, right? We're only playing inside. So if on the daily, see this inside bar, market is closed. You want to make sure the market is closed for the inside bar to be finalized. Now what you're going to do is, I already had one here. Cool. So when you first see that inside bar, the first thing, we're going to get rid of these lines. The first thing you want to do is mark the high and the low. So what you want to do is you want to mark the high and the low. Sorry. So you're going to mark the high and the low with a horizontal line like that. You could use what the magnet does. You'll see the magnet option on the left. What it does is, you see how it clips onto the bottom, either the top of the wick, the body of the candle automatically. So you don't have to like aim it and think and ask yourself, am I at the top? The magnet will automatically click on the top, the bottom of the body, or the wick of the bar. So you want to always use the top of the wick. If there is no wick like this, you use the top, but always the top of the day. That will show the high of the day. You're going to click it. Now you have a line. We're going to make this line yellow to make it a little bit nicer. We're going to thicken it up, and we're going to make it brighter. Cool. So now you have the high of the day set. Now you're going to do the same thing and do the low of the day. So this, I'm going to get you step to step. You're going to be able to rewatch this when you go, wait, what step was it next? Or what should I have done? You're going to come back to this, and you're going to be like, okay, so these are the steps. So step one is identifying the inside bar. You want to find the inside bar, and it's usually going to be the most recent days. It's not going to be back in history, but you can test these out, right? So once you do this, what you're going to do is, so this is what, September 7th. You're going to go down, let's say, to the 5-minute time frame, right? And we're going to go back to September, what was it, September 5th? No, September 7th, I think. It's September 7th, right? So September 7th starts here. You see how the price the day before went up here, came down, but on this day, it was very flat. You see that, right? You see how it just flattens out? Now, any of you guys that have played options, what happens when you enter, let's say you entered an option here for a 110 call, and it did this. Did your contract go up in value, or did it go down in value? It probably went down. Exactly. Why? Because price needs to be moving towards your strike, because if it gets choppy, your contract loses value. Because the day before, look, it was moving up. So these ones got nice and expensive. And then on this day, these people got chopped. You see how people say don't trade on choppy days, stay out of it, it's a choppy day. Everybody hates chop and sideways action. Well, the cool thing is when you play inside bars, we're playing the day after. We're letting these premiums get super cheap. So if the premium's here, let me turn that off real quick. So, question? Yeah, what's up? Juicy Ho question, you said? So when you said trade the inside bar, what happens if the next day turns into an outside bar? Okay, we'll get to that. Yeah, I'll save that question. Let me just show the. So let's say the 110 call was priced at, I don't know, $1 on the day before. So this is the Friday, because it jumped from 3 to 7. So I'm guessing it was a weekend. So let's say the 110 call. Or no, let's say people were, let's see here. 110 call was $1 here. On this day, when it chopped like this, the 110 call was probably down to, I don't know, 70 cents, maybe 80 cents, right? So it lost in price, right? Now, the cool thing is the people who were here and had the call for the next day, they lost. They're already down. The people who bought it at $1, hoping that, oh, tomorrow it's going to break out, they just got chopped. It didn't go below. It didn't go above. Is this being recorded? Yes, it's being recorded. So this is what we call trapped bulls. The person who bought on this day thinking, oh yeah, dude, the price action is super, it's at the high of the day constantly. They bought maybe at close right here, and they bought it for maybe $1. And then on this day, not only did it open lower, but then it just chopped and chopped and chopped. But it didn't break the low of the previous day. So it's still fair game. A lot of traders, what they'll do is they'll have their stop loss at the previous day's low for a call. And then the bears, or the people buying puts, will have their stop loss at the high of the previous day, and they'll allow the process to go. It's like if we win, we get stopped out, we lose. So now what happened? Now market opens. Let's see, on market opened right here. So we're going to label that. We're going to mark it. So the market opens right after this blue line. You've set your high and your low. These are your triggers. That means that if it breaks the low, you're going to play a put. If it breaks the high, you're going to play a call. So now, what's cool about the inside bar is you're prepared for anything to happen. You know how sometimes you buy something thinking, oh man, it's going to go up, and it does the opposite? Well, the cool thing is with the inside bar, you've waited for this day to consolidate and chop. The prices are now cheaper because now look, on this day, the prices got even less, right? So now the 110 call is probably at like 60 cents or something. But we're not playing. But the thing is, look, so a lot of you were thinking, oh, inside bar, I can just play calls. On which time frame do you want for it to confirm? Yeah, I'll get to that. That's a good question too. So I'll save both those questions from you guys. And then 100K group said, anyone have any platform they like for setting up charts? TradingView. The indicator that I'm going to give is only on TradingView. So anybody who doesn't have it, just give it a try. And I always say, if you're serious about trading, you could use the free version. But as soon as you start using the free version and you make some money, take some of that money out of your brokerage and pay for the TradingView, the upgraded one, so you can have a lot more indicators and a lot more things to see, because you need to spend money to make money, essentially, in the market. So let's say now it's at 0.60. So the people who bought on this day have been getting beat up completely. And not only that, now it broke the low of this day. So the people who are in here who are like, you know what, these are cheap, we're gonna play the call. On this day, it breaks. So what happens is, you know how I was saying people usually set stop losses at the low of the previous day? Well, the cool thing is you were ready for this. You already set your lines, like right now for tomorrow. You already set your lines. You have everything ready. So what happens is when it does break, typically, boom, huge stop loss rate. That's a lot of people. A lot of these guys who had the calls are exiting their positions. A lot of people who bought shares are exiting their positions because they're like, you know what, the bears won, but we're not bulls, we're not bears, we're just traders. We do whatever the charts tell us. So here you would have bought a put, right over here. So you could break it in let me see. There are indicators on Thinkorswim too, but they're not as nice looking. Okay, I got it. Okay, so yeah, if you guys can recommend it, personally, I don't use it, so I couldn't really. But if you guys, if you guys want to share the link to it and stuff in the chat, I think a lot of people would appreciate that. So here is where it breaks. As soon as it breaks that trigger, now let's say you had a couple other inside bars and you're like, well, that was fast. You know, how did you set an alerts. You set an alert at this horizontal line. At the bottom line, you go once per bar. So you just right click the line, the horizontal line, and it will make an alert at that exact dollar amount, $108.66. And what it does is it will alert you when price drops below that. I go once per bar because only once, sometimes you'll miss it and it might come back and you won't get alerts anymore. I go once per bar. So AMD is crossing. This is when you set what you wanted to do. So you go AMD crossing below 108, 66, and you have the strike that you've already set for, by 106 put. And probably you'll already have the window open. What if the price instantly reverses on you? I got you. Okay. So buy the 106 put, right? And this is a strong move. So as soon as it breaks like this, you're like, okay, I'm in, right? And so usually when I say is when there's a huge candle like this on the 5 minute, when the 5 minute is huge, you have to break it up. So usually I would say start on the 3 minute. Oh man, gotta go back. Okay. You go to the 3 minute and it kind of breaks that giant red candle. It breaks it down into a smaller piece. So like I say, for entries, I like smaller time frames because you have to be precise with the line, right? You want to be as close to the line as possible. You don't want to be buying all the way down here because you just missed all those gains. So to get close to the line at open, I like to do the 3 minute and the 1 minute if the 5 minute candle is big. If the 5 minute candle is not big, and I'll show you an example of, one where let's say it opened here and then you had enough time to actually watch it go down, then yeah, you're fine playing it on the 5 minute. But if it opens and you're seeing huge move down, like you get an alert right away, you want to break it, because what happens is, let's say you go to the 1 minute, you see that giant red candle. If you go to the 1 minute, you come to this day, look at this. Whoops, what happened? So you see here, you could have you see how here it came, tested it on the 1 minute. These are each minute of the day. Right here, it opened at 6:30, tested it, came back up at 6:31, tested it again at 6:32, broke it at 6:33. So you could have entered here at 6:33, right? And then you would have taken this trade. So breaking it down is very good usually for entries, but I say don't monitor it on a low time frame. This will freak you out. You want to be able to jump back to the 5 minute once you're in the trade, and be able to monitor it from there and keep flipping back. When people say what time frame is the best, all time frames serve a purpose. Every time frame serves a purpose. If you just stay on one, you're limiting your ability. Think about it like zooming into, I always use the art piece. There's a giant art piece on the wall, and you think of it like when you're standing all the way back and you're looking at the giant picture, that's like looking at the monthly candle and the weekly candle and the daily candle. And then you start coming in closer to look at the intricate lines, and you want to be able to look really closely and look at the the details of the picture, because you won't be able to see the details standing so far back. So smaller time frames is for entries, exits, and for that that intricate sniper like entry. You need to be very precise. But when you're monitoring the move, I like the 5-minute, I like the 15, and sometimes the 3-minute if it's getting a little choppy. What if it gaps down or up the next day? Good questions, by the way. Good questions, because I plan for all of these, right? So hopefully you guys are following, and these are good questions, and I'll run down each one when it comes. If I answer them right now, I'll get a little all over the place, but I'll kind of build you guys into it, right? So you break through, right? And you take this put down. So I'm going to start answering some of these questions. Okay, what happens if the next day turns into an outside bar? Now, this could have been an outside bar day, right? It could have broke down like this and then came back up and went up that way. I always say, play the first break. Definitely play the first break. If it broke up first or broke down first, cool. And if it was a pretty strong move and you got some profits and you see it starting to come up and break the upside, you could definitely play the upside, but definitely play with less, because you have to understand that if a stock goes all the way down here, by the time it moves all the way up here, all of this move you didn't get. So now you're risking it coming all the way back down here. So if it does break, you want it to break with some power, and we'll probably go into that after. But at least you'll see that you spotted a play. You rode the break. The break was violent because the people who had the stop losses here, their stop loss is set. Everything just, right away, and you got to ride the wave. So the cool thing is your risk to reward is a lot better. You bought cheaper. Now, I used calls because these are the losers. These are the people that are exiting, and now the bulls are taking, or the bears are taking over. You're just playing the put, and you're riding it down. Right? So another question was, on which time frame do you want to confirm it? So did that answer your question, Joshua? What time frame you want to confirm it? If the move is violent and quick off the open, you want to go to smaller time frames to get that quick, very precise entry. Now, if it opened in the middle, and it started moving, and you got to watch the price, because this is the open. Boom, right away. First 5 minutes, it's already down and broke the trigger. Sometimes that happens, especially if the market's like going down really hard or going up really hard. So for those, you want to be able to get into the 1 minute and the 3 minute just to get as close to this bar as possible when you're making the entry. All right, and then let me see. What was it? What if the price instantly reverses on you, right? So for that one, we're going to get into how to use the Fibonacci, because what the Fibonacci does is it gives you ranges to take profit and ranges to exit your position, and it's always consistent so that you always have the same risk to reward ratio. All right, but I'll get to that fib part. That's where DP, I'll answer your questions when we get to the fib. What if it gaps up or down the next day? So when you guys are starting this, I say don't play gap ups and down. If it gaps up, you don't play it unless it tests the trigger again. So let's say this thing opened up, right? Let's say it opened up, over here, and you're like, well, dang, that thing, it gapped up crazy. Well, usually when there's a gap up, there's some sort of retracement, right? Because there's not that much support here. So what happens is sometimes it comes down. Now, if it comes down and it's a shallow retracement, you're not touching that, right? You're cool. But if it comes down and it touches it, and now you're starting to see it come back up, you can take the call there. But only play around your triggers. If it's too far from your triggers, you're not doing it. And this is the thing, right? When I was talking here about, it sets clear and easy to follow triggers for entries and exits, you won't have to ask this question again, right? Because I answered it for you now. If it gaps up, unless it taps either or, the bottom or the top, you're not playing it. So now you have a rule. A lot of you guys don't even have the rules to enter and exit. You guys are kind of like, well, you know, I'm gonna go in. Well, now you have a prerequisite. You have now, you're becoming picky, right? You're having a trading system. With systems comes rules, and there comes things where you're like, nope, I'm not going in because it's not a part of my rules. Because if your rules change, your results will change. If your rules stay consistent, the results typically are consistent with that. Right? So, oops. So, are you guys following so far? Do you guys want me to go back into any part? Was I a little too confusing, or are you guys following? Thumbs up if you're following, and ask a question if you're a little following. Mind blown, lit. I'm following. Good. All right, cool. So, you know, just to go back to it, right? You see the inside bar, compression, right here. But you remember the spring analogy? The coiling? It comes here, comes in, broke. Here's an example. Where's AMD? Spring coils, breaks, boom, rocket down. Now, does it always have a violent fall? Not always. But if out of 50 trades, you're going to have pretty good success rate with when these things break. Sometimes you'll have a day where it'll break and then it'll come up and then it'll go down and then it'll come up and then it'll go down and then it'll reverse and go back up. You can't win them all, right? But this is where stop losses come into play, because I don't want you guys to get in and then as soon as it breaks up, you're like, oh my God, I need to get out. I'm fearful. We don't play in fear, right? This is a numbers game. It's about how many out of the last 20 trades were you successful in, not every single one. And I'll show you guys something that makes this very important. So with the Fibonacci retracement up here, this tool, what this does is it will give you, and I'll give you guys the settings that I have personally, and the settings that I have are probably the ones that you're going to use, and it's going to give a map layout of what you're seeing. This just looks like it's suspended in air. You don't know what is going on. But when you come here and what you do is once you click it, you're going to have to click it once at the high of the previous day down to the low, right here. Whoops. Boom. Right there, right? So what we're going to do here is now it maps everything out in like a grid. And these are fib levels, right? So when you're doing when you're going to the downside, right, you want to see the fib retracements or the extensions to the downside. Let's say it breaks the downside. You always start from top, go to bottom. You want to finish which side you want to play. So you're going to start from the top of the line, right? And you're going to drag it. You're going to hold it. And you see how that white line at the top, that 1, and there's a 0, a white line 0. These two white lines are going to land right on them, like that. This is what you're going to do, boom, like that. Now it's going to map everything out, right? And the cool thing about this is this is where, for me, this is how I've taught beginners. You can use the fib in a lot of different ways. I've noticed that when you're starting, trying to play the swing high and swing low of a move is a little confusing for people. They might not be able to identify. So all you do is you're doing the swing high of the previous day and the swing low. And now you're getting a map layout. And this is just to take profit and a stop loss. So you're usually going to take, for me, I recommend taking profit at the 0.5 and your stop loss is at the 236. It's hard to see. I'm going to try to increase the see if I could kind of increase the whatever. But I hope you can see right here. We'll move it a little over so that you can see. So you see the 236. Right here is where you're gonna. This is your stop loss. So if it reverses, you're not getting out until it touches here. And usually you're going to be taking profit right about at the 0.5. So what that does is look at this. I'm going to show you guys exactly why I say the 0.5 and why I say the 236. I'm going to show you guys, right? If you were bullish, would you draw the diff? Yes. So if it were going to the upside, if you wanted to play the upside, you would do the opposite. You would take the fib. You would start at the, you want to start kind of at the starting candle, the first candle. So you could look at the clock. You see how it says 6:30. I'm on the West Coast. So you're going to click at the bottom of this and you're going to go to the top. Same exact thing. You're going to line it up so that the lines are pretty much invisible. You see how like I see a little bit of yellow on this line? You want to be able to kind of cover it. So you're going to cover it like that. So it ends up kind of being like a white line. Bingo. Like that. Boom. So if the price, you're going to take profit at the 0.5. Sometimes it doesn't reach the 0.5, right? It's going to, kind of, come here, come there. And you'll kind of get used to it over time. But typically, as long as you have a stop loss at the 236 and you always take profit at the 0.5, out of 100 trades, you're getting a 2-to-1 risk to reward ratio. What that is, and I'm going to show you guys why risk to reward is way more important than win rate. Way more important. Everybody's like, oh, what's your win rate? What's your win rate? It doesn't matter because it depends on how much you're willing to risk for how much you're willing to get. So we're going to do this again. So we're going to put it from the high of the day, basically, to the low. And people are going, some of you are looking like, dang, well, I'm going to miss like the whole move or whatever. Don't sweat it. I got you. Okay. So you guys are right now, I'm going to just kind of add a little commentary in between. This is not the time for you to be making money. I get it. You guys want to hop into the market and make a whole bunch of money, right? But first, what you need to do is you need to have a trading plan or a strategy that you use, like this inside bar. You need to have a system where you take profit. So you go, you know what? I trade the inside bar and I do a 2-to-1 risk to reward ratio. Bingo. And you do 50 trades of that and you document it. If you do that, you will, I'm telling you right now, you're going to be so much better at trading than you would have if you followed some other random people and just, got in when somebody told you to get in or whatever it is. Because what this teaches you to do is it teaches you to look at things as in big numbers. If you look at every trade as one individual trade, you're going to be emotionally involved. You're going to be like, I need to have this to win. I need this trade to win. I need it to win. When in reality, if you look at it like coin flips and you go, okay, out of the next 20, I just need to get, and I'll get to that. But, just look at things like a bunch of trades. Try not to be emotionally attached to every single trade. The best way to do that is to become like emotionless, a robot. Just systematically, I've given you basically the most objective way to trade possible. There's no feelings in this. Identify inside bar, boom. High and low, boom. When it breaks, you enter. You take profit, 0.5. Stop loss, 236. It shows this price number. Are you drawing fib lines based off the inside bar high or low? Exactly, yes. Thunder said it. Walk before you run. Because I promise you, if you guys are chasing the money, you're gonna blow your account. You're gonna get a lot of money at first. I would say in the stock market, it's not about making money. Everybody makes money. You see everybody posting all these screenshots. Very little people keep the money that they have. Why? It's just like in Vegas. How many people make money in Vegas in a night? There's first time people who throw money on roulette make money, but they never keep it at the end of the night. They're always out. They're always down bad. The house always wins. Why? Because those people don't come in with a strategy. They just come in to play and get money. When you got your eye on the money, you're going to lose. I promise you right now. So just write it down somewhere. Be like, if I chase the money, you lose. What you need to do is find a strategy that works, and the money is a byproduct of it. Right? So, for your previous high or low, just making sure I got all the questions, right? And I'll have these fib levels set. They're a little different, so I'm going to show you exactly. So if we go to the short position, this thing, what it does, it shows you your risk to reward. Right? It's right here, short position. And what you do is you click on the line of where you entered and you put your short, and this is your stop. going to move it over like here, and it's going to show you exactly what your risk to reward ratio is. You put it at the 0.5 and look. This is how much you're risking, and this is how much you're getting. Now, if somebody said, hey, let's play a game, I'm going to flip the coin, and every time that, you know, let's say that you pick heads. You're like, all right, I pick heads, and he picks tails. He goes, you know what? Every time you go heads, I'll give you $2. Every time I go tails, you give me $1. Would you guys play it? Thumbs up or thumbs down? Would you play it? Would you play that game if somebody said, okay, every time you win, I give you $2. Every time you lose, you give me $1? Bro, that's free. Come on, that's free money. That means you only need to be right how much of the time to get that money back? You know, not as much. What did you say? Depend on So, you know, this is why I say risk to reward ratio. I'm going to train you guys into thinking risk to reward. You're going to look at things as, okay, how much am I willing to risk? People don't look at risk. They just look at reward. People will overbuy, increasing their risk, and then they're going to just to you know, focus on the reward. You have to understand that. Like DP said, this thing can reverse on you right away. You have to think of it like that. So you have to size your trades accordingly. So, are you gonna post the indicator after webinar? Yep. Yeah, I'll set you guys up with everything right at the end. I'll have it all posted and all that. It's in the the indicator is in, I think, TA info. Yeah. So if you go to TA info, I'll send the link in. Copy link. Where is it? Any questions? Bingo. That's the trading view one. So you want to look at everything. Basically, what I want you guys to think is, if you're not getting at least a 2-to-1 risk to reward, you shouldn't trade it. You shouldn't even trade it. You should just be like, nope, I'm cool. I'm not interested. You know why? I'm gonna show you guys. I wrote it over here. Bingo. So when I say manage your risk, this is what I mean. A lot of you guys have a 1-to-1 risk to reward ratio. Whoops. What's going on? A lot of you guys, what you guys do is you guys are 50-50. You might make 500 and then you lose 500. Or you might make, 1,000 and you lose 1,000. And then some of you who your accounts are down, you guys might make 500 and then lose 1,000. You guys have the opposite, right? You guys have a 2-to-1 risk to reward. And then you need to be able to win 75% of your trades in order to be profitable. But look at how much you have to win in trades. That's you. Hey, I appreciate the honesty, guys. I know you guys are here to learn, so that's what it's here for. But I'm gonna set y'all up. All right, I'm gonna set y'all up. So risk to reward. When you have a 1-to-2, which is what we had there, you only need to win 3.3 out of 10 trades to be break even for no loss. You only need to win 3 out of 10. Imagine losing 7 trades and still be chilling because you're even. You're like, okay. Imagine only winning 33 trades, losing, whatever it is, 66 trades. You could lose 66 trades, make 30, just win 33, and you're even. You're break even. You haven't lost anything. And then look, if you go to a 1-to-3, you only need to win 25%. But, usually 1-to-3 is a little bit harder to attain. We start with 1.2 until you build your account. Then you start playing, 1.3. I mean, 1-to-3 risk to reward. Look at the loss rate. Imagine going into the market knowing that you're going to lose more trades than you're going to win. Are you going to be as emotional? No. Because you know that all you need is 1 trade and it'll pay off 2 trades. 1 win will pay off 2. You guys following? Have you guys been familiar with risk to reward? Is this new to you, or are you guys familiar with it? Let me know. New to you? Cool. Brand new? Lit. Heard about it? Cool. Yeah, hopefully this thing is starting to, hopefully the wheels are turning in your guys' head. You're like, oh, okay. There was this one hedge fund guy who he only traded 1 to 10, I think, and his win rate was like 12%, or like, I don't even know, it was like 8%. He only won 8% of the trades, but that one that he did win would pay everything off. How does time decay work with 2 to 1? So so it depends, right? So if you're day trading, the time decay, if you're going to day trade, time decay isn't really, I would always say if the trade isn't working by, let's say halfway into the day or something like that, and it's just flat or it's not doing anything, then, ideally I would say just get out, just so you don't, exactly how you said, get the time decay. On a swing trade, you usually get more time on the front end, for if you're swinging like a weekly inside bar, I always give people, I say give yourself a month to avoid the time to battle the time decay. Also, let me see. Let me see. So you should usually plan out a trade before you get into it. What does that say? When playing options, do you put in stop loss once you get in the play, or do you wait till the stop level is broken? Only asking because the longer you stay in the trade, the premiums get killed. Exactly. I totally understand. And like I said, about if you're going through halfway in the day and the thing is not moving, just consider that a loss, right? Or get out. Or you could hold on to it and assume the risk, right? That's your choice. But I would just say, usually we're trying to play these breaks, and if these breaks aren't breaking, right? If it's just hovering around the trigger, then ideally you're going, okay, you know what, this one's not working. And then sometimes you get out of the trade and then it'll go, but that's fine because we're trying to mitigate risk, right? You're trying to mitigate risk. You're not trying to make money. Thing is, everybody, like I said, everybody makes money. The less money you lose, the more money you actually make. That's how you actually make money in the market, is the less money you lose. It's not about the more money you make, because the more money you make, typically without a plan, it's just the more money you lose. You're just getting into bigger trades and getting more euphoria and going a little crazy. But with the fib, let's see here. This is predefined. There's a dollar amount here, right? Because we're playing off the price action of the move. So here, I can't see. Where is it? 109.11. So what you're saying is, hey, from here, 109.11, I'm out. But if it goes all the way down to 0.5, I'm in. And the fib is only going to give these levels based off how big the low and the high is of the previous day. So it's measuring based off the history of this stock's move of the previous day. It's not going to do something very outlandish. Like the 0.5 isn't going to be all the way down here at 105 and making it less attainable. It's all based off the previous day's move. And the previous day's move is somewhat of an indicator. But sometimes like this, look, it will blast right past it. So I'll send you guys the indicator. I'll show you guys a screenshot of the fib, how I have it set, and then you guys can practice doing it. If you guys have any questions about that, you guys are learning, cool. Are you guys following right now? Am I just blabbering, or is it things are making sense? I want to kind of check in with you guys because I go on these kind of long rants sometimes, as you can tell. I'm following you. Good, cool. So far, to recap, you guys lit. I like the responses. Thank you. I'm listening, but waiting for the setup. Cool. Boom. Joshua, did that make sense with the time decay on the 2 to 1? If you're day trading it, you don't want to just keep holding it all day. If it's choppy, you want to be risk adverse. So you're out. And the thing is, look, and you have to assume, right? Just be like, all right, cool. Even if this thing just starts, running down, as soon as I sell, it's cool because my criteria is I'm trying to, play that first leg of the day or that immediate break. That's what I want. Because if it's hovering around it, typically that means there's a lot of support there. So there's a lot of people, and sometimes they'll go in the opposite direction, or a lot of resistance there if you're playing the upside. Wondering whether I can have the same setup. Yeah, cool. Yeah, help each other out. You guys can share. We're all here to just help each other trade. So now you know how to identify an inside bar. We're not going to talk too much about outside bars for now, because I don't really trade outside bars. They're just an indicator of big movement. But what we're going to do is just focus on the inside bars. Cool. And then what else did I have here? What makes it so powerful? It teaches you to scan for plays every night and over the weekend on your own. Do you need my help to find an inside bar after you have the indicator and you have a watch list? Nope. Ask the people that have already learned how to play inside bars. Nobody asked me for any of that stuff. They just asked me all the extra stuff of, the more advanced stuff of trading. But to catch inside bars, I'm teaching y'all how to fish, So what it does is you scan through, you find your inside bars, you mark them, and then you set your lines, and you can even set your fib ahead of time. All of this could be done without this happening, because we're just playing the high and the low. We don't even need the price. So you can have your whole trade planned out the day before, and all you're doing is executing. You could sit here and go, you know what? All right, high, low. You can have the fib coming here, and then you can have the fib going up top too. You can have two fibs at the same time. You can have one coming from here to here, here to here. Oops, let me get that going. Like that, right? And then you go, cool, stop loss, 236. You can even mark it. Sometimes I like to use the little rectangle and just put in the 236 like in there. Okay, cool. Just to highlight it. How to confirm bullish or bearish after inside bar after close. So that'll take a little bit more experience of watching price and how it moves. But I always say don't anticipate when you're starting. Don't anticipate anything. What you're gonna do is just react to what it shows you. I know it's fun to fortune tell and figure. Oh yeah, I knew that was gonna happen. But in reality, anything can happen the next day. Buyers can come in. Good news can happen overnight or in the morning. The market can take a crap the next day. Anything can happen. And so what you want to do is prepare for both sides. That's what I like to do. I like to be ready for whatever. I don't want to be caught, not knowing what to do. So I set an alert for there, set an alert for the top too. So I have here, you already have your take profit zone right there at that 0.5. You have your stop loss set. You have your stop loss here set too for the downside, and you have your take profit. So now when I get rid of this stuff, you'll kind of have a range to play in. So now when I get rid of that and I get rid of this, it's basically how you're playing it. You're playing within these. I'm cool. This is my stop loss. If it comes here, and I would say if it taps it, don't get out. It has to actually close. Like the candle has to close, below the number. Because sometimes and you'll see it a lot because it is a fib level, and a lot of other traders and algorithms use the fib. You'll see it tap it and then come right back. I like how you can prep night or weekend before. Exactly. You're prepping for the whole day, so you're ready for the day before it even starts. You don't have to worry about, I got to find this player. This also stops you from chasing plays. You see how this is like perfect for a person who's a beginner? It literally covers everything that you need to do and stay away from when you're starting trading, and it puts you on a plan. Do you look for anything else when a play fake a break on the downside and heading to the upside, but might be extended? Do you still go in as usual? I would say I'm trying to keep it as strict and for when you're starting. So those kind of things are typically things you would want to do when you've already probably done your like 40-50 trades and you understand it. Then you can play it. So I'll answer it, but I'll honestly recommend just play one side. Whichever side breaks first, play that side, play the momentum, and then that's it. If it goes and comes back up again, again, I don't want you guys to be, over trading essentially, or getting, kind of greedy and wanting to play both sides and all that. I want to get all that out of your system. And, when the inside bar, when you've played the 3 trades or whatever trades that you're playing for the day, once that's done, you go, and for the rest of the trading day, you're just going to document what you saw. You're going to be like, all right, cool. And you're trying to analyze exactly why it didn't work, and then that'll help you later on. Here's a good way I have learned fibs. Buy put. What is that? 0.5. Stop loss fib reverses by calls. Bingo. 0.5 is the most common versus sell. Cool. Who in the server is best at option spread, Cedric? This guy right here. I don't know. Oh yeah, I did read a question about doing spread ones. You should ask Cedric. I think he has videos on his YouTube channel of them. I don't do spreads at all. My little thing says high risk options. I just do one-sided. I either do calls or puts. How do you choose the strike? Joshua, you're asking all the questions. Like, it's almost like I paid you to ask the right questions at the right time or something. So, do you look at volume 2 when it's breaking? Yes, I look at volume 2, and usually if we put up the volume bar, you'll start to see that volume kind of spikes sometimes on the break. And what happens is that's usually like a stop loss. That's the momentum that you're riding. If there's a strong break, I'm a lot more confident on it. If it's a weak volume break, then I'm a little apprehensive. But still, play the inside bar, do 50 trades, document them, and I'm telling you guys, it's gonna be a good one. So, how do you choose the strike? Look at this. Look what I did right here. Bingo. Come on, I was prepared. I was up all night. I was like, you know what? I'm gonna set this thing up. Bingo. It looks crazy, but I'm gonna have it understood. I'm telling you guys, I take this stuff serious, right? So, and if you guys want shameless plug, if you guys want one-on-ones, I do one-on-ones for 90 minutes, $35. I'll set you guys up to whatever you personally need, like a one-on-one kind of thing, and I'll have that. I'll put it up on my thing, but I have dates coming up for next week. I made it affordable for people, but just understand, the better I get at this, price will go up, you know what I mean? But cool. So how do you pick a strike? Take the previous candle, subtract the top price from the bottom price. As I will Rod, I'll repost this on my alerts. So you see where it says Amin alerts? Right there, I post it afterwards, and I'll try to timestamp it as well. So I'll rewatch it, timestamp it, and put it up. So what you're going to do is, you see the candle, you're going to take the low price, which example, if the low was 142.50 and the top was 152.50, you're going to subtract it. That's a $10 candle. So you see the $10 candle, you're going to do the same thing for the previous 5 candles. These are daily candles, by the way. I probably should edit that, but you want to look at the daily candles. Why? Because you're doing a day trade, typically with an option, a weekly. So you want to know on the last 5 days, how much did it move? Because you want to be realistic with the move. So you want to use its previous history to give an expected move. So once you get all 5 of the numbers, so this is a $10 move, this is an $8 move, this one moved, 7 days. Diamond, I only trade large cap. I don't really do small caps. Small caps have less volume. They're a lot more volatile. Random news will completely obliterate it. I'll give you guys my watch list, but I like big caps because they're a lot of volume. They move a lot, and you can make a good amount of money off a lot of these. So what you're going to do is 5 candles. Add up the daily size of each candle, and you're going to divide it to get the average. Now that's the average move from the bottom of the candle to the top. I say divide it by 2 to be conservative. So if it moved $1 one day, $3 the next day, $5, then $7, and $9. And the average here is a $5 move. Subtract it 2.5 and you'll get the average. You see how if you did like 1 and 2.5, it starts to make sense. You're like, okay, if I did a $2.5 strike from here, it would have actually been, you know, a pretty good strike. So when picking the strike also, and you'll be able to review this, I'll have it recorded so you can kind of, I know it's a lot of information, you'll be able to review. First tier, when looking at strikes, highest open interest and volume usually end in 0, 5, 0, 5. Here, now look at the strikes in that range and look for ones that end in 0 or 5 first. If those are too far away, even numbers work best. Second tier, normal open interest and volume, 172, 174, 176, 178. Bottom tier, these are the ones typically you want to avoid. 172.5, 173, 177, 179. You want to avoid these because if you go right now and you look at any stock option chain, do this for yourself, just test it. Click on an option chain that's like near the money, look at the next couple of them. If it ends in a 0 or 5, probably the most open interest and volume. That means there's a lot of, it's very liquid. There's a lot of people coming in and out. And you want to be able to have that because when you want to get out, you want to be able to have somebody that's there to buy it from you. You don't want to be waiting and then you get that slippage and all of a sudden now it's, you know, it's getting lower and lower and lower. So does this make sense? You take the top and the bottom of the candle and you average it out from the last 5 days. You'll be able to do this pretty quickly because you'll just look at the candle and be like 152, 142, that's 10, that's that, that's that, that's that, and you'll just be able to go, okay, cool, you know, the average is about 8, so I'm going to do like a $4 strikeout. So to give an example here, let's go, so we did, what was another question? Are you making these trades any time of day or just the beginning? You want to do it when it breaks. Sometimes it'll break later in the day, but ideally you want to be able to do it in the first half of the day because that's when the most volume is and that's usually when the biggest moves happen. Can you just do the nearest strike to the break? Yeah, so you can, Trey, you could do that too. Some people can't afford it or some people want to be able to, you know, maximize. Personally, I say, you know, the rule of thumb is don't go anywhere farther out than 3 strikes. You know, but sometimes for stocks that move a lot, like they have big moves, the in the money is super expensive, and then you go, you know, $10, $20 out of the money and they start getting a lot more affordable, but it actually can reach it too. So you're not just taking those really cheap ones because it's, you know, it's like a lot of way out of the money, but it's actually a realistic range. You know, the vaccine stocks used to be like that, like Moderna. Once it's in the money, let's say it was at 380, the contract's at like 1,200, or like at the money was like 1,200, but $30 out was, you know, maybe 300 or $200, but it had a $50 move the other day. So that's why I say look at the average of what it does. Wait, so the number you get after dividing 2 represents the dollar or number of strikes you should go out. The dollar amount. Like, you know, it should be a strike that's, you know, so for this example, it's a strike that's $2.50 out of the money. If it was like a 5 divided by 2. Yeah, it's not by strikes, but it's by it's basically showing, you know, average dollar amount. We're going to be conservative because we want to be, you know, we want to be safe. And the cool thing is, if it does have a $5 move, you're going to go from out of the money into in the money, or at the money, and then you're going to go in the money if it has like a $5 move. So you're going to get all three like nice little boosts. You're going to be out of the money, you're going to get that nice little premium rush coming in, and then you're going to get that nice, you know, theta decay protection. Right? So are you guys following so far? Following? Cool. Let's get thumbs up. Who's alive? I have a sore throat, man. just know that I'm doing it for y'all because I care. And I want y'all to come back and be like, holy shit, this thing is amazing. It's like, I trade so much easier. You know, whatever. So, cool. Bet. So, right. So, the other thing here, thank you, Scoop. Thank you guys for responding. So why else is the inside bar strategy powerful? You can use it for day trades, swing trades. So some of you guys maybe don't have, I want to start off with, if you guys are doing day trades on Robinhood, don't. Go get Webull, or go get, what is it, TD Ameritrade, or any other place that has a cash account. Robinhood is a margin account. And what's cool about it is you get instant deposits, but also you can only do the 3 pattern day trades or whatever per 5 trading days. So the issue with the PDT, and I hear that a lot. I hear people like, I'm in a trade, but I can't sell until tomorrow. Not only are you putting yourself at risk, but you're also slowing down the amount of trades you can do a week. If you have a cash account, right? Let's say you have a $2,000 cash account. You can trade that whole $2,000 any way. You could either put it in one option for the whole day. It's about your balance. So you could either trade your whole account, which is $2,000, on one option. You could buy an Amazon call or something, or you can do 20 small $100 trades, and then it resets the next day. So imagine how many trades you guys can do on a cash account. What Robinhood is good for is spreads, because margin allows you to, to do spreads. But on a cash account, I'm telling you guys, you don't want to get locked out, and you don't want to have to make that choice of, do I get locked out or do I lose all my money because I'm in a trade? Don't do that. So for all the people that are day trading, get a cash account. That doesn't mean delete your Robinhood. You can keep money on there, and you can do, I think Dead Man Walking, you said that you use Robinhood for spreads, and then you use a cash account like Webull or something for day trades, right? Webull for cash day trades. Bingo. And it works good, right? So now you can do both. You have 2 different accounts. You've spread your money out so that you have documentation of how your spreads are doing and documentation of how your day trades are doing separate. Because if you do both of them on the same place, you don't know what's doing good and what's not doing good. I have TD margin for spreads and TD cash for day trade. Bingo. You got it. See? So cool. And so I'm going to show you guys how to catch swings on them. So you guys now kind of understand how to do a day trade with an inside bar, right? So we'll recap. Whoops. What am I doing? So remember, pressure, right? You see it, you spot it on the daily time frame minimum. So we can do it here for the SPY. See how price, look, I'm going to show you guys, you see how the price went from all the way up here and pressed it down there. And then you see the price come from here and press it down, right? What do you think happened to all the people who bought puts down here? They're all squeezed into this thing. Look at all the people that bought calls up here. They got squeezed in here. So how I was taught was that there's trapped bulls and bears. Somebody is going to win. Somebody is going to win this battle between the bulls and the bears. But in the meantime, they're both trapped. The premiums decayed today. So tomorrow, you're going to have the levels on the SPY of 465.30 for a call, 463, 75 or whatever for a put. If you're having trouble figuring out what the real bottom is, never eyeball it. Eyeballing it will mess it all up. Hover over the candle and you'll see up here. See up here how it says HLOC? This is open, high, low, close. you want to mark the high and the low. Make sure you're highlighting the exact candle, because if you move it over, it's going to give you the wrong data there. So whenever you set your lines, confirm with the top. Always confirm up here. So now tomorrow you get to watch what happens with the SPY. That's a good one to test, to see, you know. And then now you can use its previous moves. So you have, okay, 467 all the way down to 462. What is that? That's what is that? $5 move. Now you're gonna go to the next one, 469 to 465. It's a $4 move. So it's a $5 move, $4 move. Here we have 470 to, that's a $2 move. Here we have 470 to 467. What is that? $3 move. What is that? So 1, 2, 3, 4, 5, right? So here you can see that a $4 move seems to be pretty reasonable. So, but you're going to divide it by 2 because you're going to be conservative. So you're just going to do a strike $2 out maximum. So now we're going to use AMD. We're going to go to the weekly candle. This is for the people who, you know, have to be at work. You know, they can't really, you know, they don't have enough time to be at market open. You know, they get too overwhelmed, constantly checking. You do the same exact policy, right? The same exact one, but now on the weekly time frame. So we found this weekly inside bar went up to, I think like 3,000%. This weekly inside was crazy. I missed it, unfortunately. That 107 break, I had an alert on it and everything. I got distracted, didn't take it, and then AMD ran from 107 all the way up to 155 in a matter of 1, 2, 3, 4, 5 weeks, basically. But this would be like the week. So how do you play this? The exact same way. You look at you find the inside bar on the weekly time frame. You get this, pull it down to the low, right? And you do it to the high. Now you have the range. You set your alerts, and now you're going to do the same exact thing for your strikes. Use the average weekly moves to get a strike. Divide by 2. I already did it previously, and I think it was like 110 was a good strike. So at 107, I had the 110 calls set for a month out. A month. I like a month, DP. So the reason why I like a month on the swing is because since you're holding for, but you're going to play mostly just the 2 weeks. You could play more if it's going in your favor, but by 2 weeks, you should be looking at taking, closing your position for the most part. Why do I say that? Because this will take a week. This will take a week. If you did an expiration on this week, you would already be getting a lot of time decay during this week, and at the start of this week, you would have had your contracts killed. But if you have 4 weeks out, you have that 2-week time decay cushion. That 2-week time decay cushion allows you so that if it's in your favor, you get to ride it for 2 more weeks. If it's kind of being choppy and it's not doing too much, you can exit without getting chopped up by the time decay. Exactly, Val. You got it. So you pay for time, but you exit prior. And the thing is, if it's in your favor, like with this AMD, it's already, you know, up to 120, and you still have 2 more weeks into it. You're like, all right, cool. I'm gonna let this thing ride out because you're $10 in the money and it can keep going. So weekly inside bars, same concept as a daily inside bar. You go to the weekly time frame. Now, I want to make sure you guys understand. The weekly bar closes every Friday. You can't look for weekly inside bars during the trading week. You can't look for it today or tonight. You have to let the candle close. It's going to show inside, but the candle's still being able to move. You want a candle that is solidified, closed. It's in history. It can't change. You never want to play or make a decision off a candle that's moving, because it could just, as soon as you get in, it could do the exact opposite, and you don't even have like the evidence to show it was. It could break and then not become an inside bar, and now you jump the gun. That's called being eager. We're not trying to be eager here. You want to be, so for swing plays, Friday after market close or over the weekend, you can even do it Sunday. That's when you start setting your lines. You start setting your strikes. You know, you figure out what your strikes are. You start doing your, so for the, sorry, I need some water, man. So I joined late the lecture. Do you explain how to find these inside bars? Yeah, Dirty. I have it recorded though, so you can just rewatch it and take in whatever I'm saying now, and then you can kind of go through it. Yeah, cool. So, but yeah, inside bar, wait for it to break. With your stop loss, you can do the same thing. You do high and low. All right, so do it like this. You can get, but you know, just to keep it steady and straight, you want to be able to just do this one, the 613, and the 0.5, because we're trying to get that 2-to-1 risk reward. So that means sometimes you'll miss out on big winners, but you'll also be protected from huge losers if it happens. You guys follow the swing? It's essentially the same idea, bigger time frame. The cool thing is, a weekly inside bar isn't as common, and that means it chopped for a whole week. It was you know, sitting within that same range for the whole, so the calls that you're picking for a whole week didn't change from the previous week. So the best kind of inside bars, right? The best kind of inside bars are the ones that look like this. Whoop. Why can't I click it? Like this. Whoop. Okay, I can't, but whatever. So we're gonna, you know, we're gonna move these right here. I'll show you. Actually, you know what? I'll show you on the SPY. SPY is this is a really good inside bar on the daily. Why? Because price, you can see it really, the harder it condenses like that, think about it like the spring. If you have a spring but you only bent it here and here, and the inside bar is pretty big, so let's say like AMD, you see how this inside is very little? See how that wasn't that big of an inside bar? You can still play it, but the inside bars that are good are these, because everything is compressing, which means that, you know, whoever wins is gonna, you know, they're gonna really win, and other people are gonna get out. This weekly inside swing is great news. Yeah, so, you know, you could do this. You can even do it with the monthly. You could do quarterly swings. You can do, I think, what just had it? I think it was like MU. You can go to the monthly and do the same exact thing. All right. Now, the thing is, the longer the time frame, the less I want you guys to be playing puts. Why? Because overall, the stock market trends up. So if you're going to get a put for 3 months out, I would say don't do that. Even when it comes to the swinging weekly inside puts, take profits quickly, because anytime you're in a put, you want to be thinking, I'm scalping, I'm taking profits quickly. I'm not trying to get a home run, because the market trends upwards, and generally the downsides are usually just breathers before a bigger upside. So you don't want to be caught holding too long in a breather, and then all of a sudden, you know, that thing just jumps out at you. Said, as he said, you can't play off current week. The bar has to close off inside bar. For the break, it has to close it. Oh, so when you're good question. So when you're playing the break, let's say, let's use AMD as an example. So for the weekly, so for this one, right, you're wondering, hey, well, you know, Am I going to have to wait for the weekly candle to close? No. A daily is good enough, right? Where is it? Oh, man. I think this was the inside here. A daily close right here would be nice. If you want a more laser-like entry, you can go down to like the 1 hour and get a good 1 hour close. But understand that the smaller the time frame you come in, the more chance it has to kind of come under, right? But so here, like that 1 hour candle, when it broke, you would have had the alert. You could wait for the next candle to close above, so it doesn't just wick down right there. You could have taken it, and then you would have rode a swing October 13th, expiring. What is that? November 13th. So you would have still been in it. I looked at the contracts. They were $1 here. I think they went all the way up to $35 a contract here. So you could have turned 1,000 into 35,000 off this swing. And all you were doing was soaking in that money. Now, I want to make a point. All of this stuff works when you have at least 2 contracts. If you're only buying one option contract, it's hard to make decisions because it's an all or nothing decision. You can't make 2 choices at the same time. And sometimes the market will make you choose between 2. And the best choice that you have is to make both choices when you're faced with that. When there's a fork in the road, you're better off having 2 contracts, set them separate ways, and whichever one works and whichever one doesn't, they usually cover each other. 3, I like 3 personally, but I understand that some people have smaller portfolios and they can't buy the contracts outright. And I always say, if you can't afford it, just wait. It's almost like you're graduating to trade that stock when your account is bigger. But definitely get at least 2. Why? Because when people ask me, hey, I'm a little nervous, I'm afraid the market's going to go down tomorrow, should I sell before close? Well, if you had 2 contracts, you can sell one and hold the other. If you have 1 contract, you're constantly thinking, is this the whole move? Oh my gosh, can I should I hold on a little bit longer? I'm getting a little afraid. Well, if you have 2 contracts or multiple contracts, the more the better. I know, look, Val, look, I know you say so true, because I know I've been in that position a lot. And the worst thing is when you get in a trade and it's going crazy and you have 1 contract, you're up like 80 to 100%, and you sell it, and then you look back later in the day and it's up 700%, and you're like, why did I sell? Well, that messes with your mental, and then all of a sudden the next trade you're going to hold on to it longer than you want to, and then it's going to reverse on you, and you're going to be like, why did I hold? It's very confusing. This is why you always have more choices. Don't put all your eggs in one basket, essentially. One option is putting all your eggs in one basket. Spread it out, meaning you're going to have multiple ways to do it. Is that sticking with the plan? Yeah, so this is what I was saying, right? So we'll do the example of the what was the date? I'm going to show you guys. So on this AMD play, I'm going to show you guys something. On this AMD play, now that you have, let's say you have 2 or 3 contracts, and this was your first take profit, you can have, let's see. So we set the fib, right, to know where our take profit is, to have a 2-to-1 risk to reward ratio, and it was around right here, and it nicely consolidates, so you had an easy time getting out of it. If you had 3 contracts, you would take profit here, let it keep going, and now your stop loss is here for the next ones. So now what you're saying is I would have sold all of these here, but since the move is pretty powerful, I'm going to keep riding it, and I'm going to take profit at each other fib level to trim it off. And if it does come back in reverse, and that was the bottom, I sell out at the 0.5. Does that make sense? So, hey, thumbs up if it makes sense, thumbs down if it doesn't, or ask a question. Thank you, Panda. So are you guys going to buy one contract from now on? Nope. We don't buy one contract. The only way you buy one contract is if you're doing a lotto. Let's say you're going, I'm just going to, I'm going to play with it. It's just, I'm expecting 0. I'm going to play with it. Cool. Then you understand that that's what it is. But if you're making, a serious trade, you want to be able to have enough to get rid of it. You sell first at the 0.5. I've been holding till the 618. So, Deadman, this is just my way of teaching. Everybody has a different take profit area or all that. The reason why I say take it at the 0.5 is because sometimes it doesn't reach the 618. And if you look at the risk to reward here, if the 236, which is this fib level, is your stop loss, and you take profit at the 0.5, you're at a 2-to-1 risk, a 1-to-2 risk to reward ratio. So if you're following with this, you know that you only need to win 33% of your trades to break even. So let's say you guys are 50-50. You win one trade, you lose one trade. Well, if you're 50-50 on a 2-to-1, you're profiting massively. You're up. Your portfolio is looking up, and it just keeps going up, and it keeps going up. You see how some people, and you might relate, their portfolio, it kind of goes down, and then it's like a huge drop, and then it goes down, and then it's a huge drop, and then it goes down, and then it's a huge drop. It's like a staircase of red. Why is that? Because you're not sticking to a plan. You're risking more than you're okay with risking, and you're doing big plays and you're losing. So then it just keeps going down and down. Once you get enough of these right, you're basically trading for free. Let's say you get 10 of these right. You get 10 good inside bar trades, right? 2-to-1 risk to reward. That means that you can now lose, what is that? What is that, 10? You can lose 20 trades in a row. You can lose 20 trades in a row and then break even. And you think you're going to lose 20 trades in a row? No. This is how people keep their accounts going up. Have you ever seen people who are good traders and their account just keeps going up and keeps going up and keeps going up? It's because they have usually minimum 2-to-1 risk to reward. So your losses, they sting a little, but the profit will cover. And because we all go through losing streaks. We all do. It's called the drawdown period. Every trader, no matter how good you are at anything, you're going to go through a drawdown period where you just end up going in the wrong trades, or the market's just kind of, you're making the wrong assessments, or you just, the trade's just not going against you. Well, if you have a good risk to reward ratio, it's already baked in that you're going to still be in profit at the end of it. But if you're 50-50, you go through a 4-loss streak, you're down a lot. You need to win now, not only, you need to win more than, you need to win more than 4 trades in a row again to come back from that. So risk to reward also allows you to come back from a loss a lot quicker. Good work, guys. Can you post your fib levels when I'm done? Yep. So I'm gonna actually take a screenshot right now. Put the settings in. Try to copy it exactly how it is. So these are the same. These are all how they're supposed to be. This is the important part. I take off the background, because if it's not, you're gonna probably pull it out and it's gonna look like this with a whole bunch of colors. I don't like that. I take it off. I just want the lines. Take off the background. You're gonna set the numbers in the exact same spot with the exact same colors. I do purple, and I put the opacity a little low so I could actually see the candles. I don't like it too bright. And then for the bottom half, it's all green, and then there's gonna be one white. There's this one here. This is an extra one, but don't worry too much about it. We're not looking at retracements too much right now. This is just for your stop loss and your take profit. This is better ideally for people who don't really know how to set support and resistance, and we can build on that. But can copy said, did you cover using fibs earlier? Yeah, trades. I did the like beginner way to use fibs. So I didn't go over actually using a fib on a leg, right? Where you do the swing high to the swing low, or the swing low to the swing high to get a fib. What I did is the beginner way, which is you use the high of the previous day and the low of the previous day in order to get fib levels for to take profit and to have a stop loss set. ESG said, could you recap real quick? All right, cool. I'm gonna do like a 5-minute recap real quick just to like speed it up. All right, cool. So inside bars, right? So there's 3 types of bars. Continuation bars. These are ones that continue a trend. It could either be a bullish continuation or a bearish continuation. This is the bars you mostly see here. This is a bearish continuation. Then we have a little bit of a bullish continuation, bearish continuation. And every once in a while we get an inside bar, which what it does is it doesn't continue in any direction. It actually consolidates the move. And that's a moment for pause. The market is now pausing real quick. Now when that pause happens, it traps bulls and bears, and we don't know which direction it's going to go in. So we plan for it. We set the high of the candle, the low of the candle, and whichever side the decision of the move comes, we break it. Why do we play inside bars? Because look how often there's a double inside bar. Rarely ever a double inside bar. What does that mean? That means that for every inside bar, it's almost guaranteed that it's going to break one side or another. So that's a part of high probability trading. If you're going to play a high probability setup, you know the probability of an inside bar turning into a second inside bar is rare. They happen, and when they do, that just means that the consolidation is even tighter. So that's a even better thing of, okay, a double inside bar is going to look really good. So outside of that, there's outside bars. These are ones that are basically engulfing candles. They engulf the previous candle. The previous candle is called the mother candle. This is the mother candle. This is the inside bar. Here's an outside bar. When the best setups, this is called the Holy Grail setup. When an outside bar is followed by an inside bar, typically what happens is it's a huge, where is the arrow? Outside bar usually has a lot of volume. You see how the volume is really high here compared to the other days? So that means there's a lot of puts and a lot of calls coming in here, which means there's a lot of trapped bears and bulls. You come here, you squeeze it in. Whoops. Hold up. So I like this arrow so much better than the other one. So trapped. These bulls from up here, let's use this as an example. From here all the way up, this whole range of the wick, all of these people who bought calls thinking it's going to go up, the next day they got squeezed into here. All the people who bought puts, this whole amount squeezed into here. Whoever wins is probably gonna, they're gonna get a nice move. Boom. Next day happens, it breaks the top. You play that whole thing right there, and that's kind of how you play the inside bars setup. So best setups are usually double inside bars, followed by the Holy Grail setup, which is an outside bar followed by an inside bar. And then the ones that we play most of the time are just inside bars, and they vary. So if an inside bar is small and tight and the mother bar is pretty big, it's better. If the inside bar is the same size as the previous bar and just a little bit smaller, there's not that much compressing going on. So it's usually a move isn't going to be as big. More compression, bigger move. Right? More compression, bigger move. That's usually how it goes. So now with this indicator, the gold line is going to show whenever there's an outside bar followed by an inside bar, which is, they call it the Holy Grail setup. Don't think that just because it's a Holy Grail setup that you're going to make, a whole bunch of money and everything. No, it just means that on this day, there was a lot more volume And then on this day, there wasn't that much volume. And so the compression's happening. So inside bars don't break either side of the previous candle. Inside bars can be bullish or bearish, which is great for you guys. You can play either side of it, and they're compressed. Why are inside bars powerful? It has objective preconditions and identification. There's no asking somebody if this is an inside bar. It's either inside the previous bar or it's not. There's no, when you look at the MACD or you look at the RSI, you might be like, I mean, it is kind of oversold, or hey, the moving average is kind of doing this. No, inside bar, it's either is or it isn't. Once you find the inside bar, you have a high and a low. That's final. There's no second high or second low. You do the top of the candle, and that includes the wick, the top of it. That's the high of the day. That's the low. And then you're going to play whatever side breaks. Now, when it breaks, let's see. Where was it? Here we go. So this was an inside day. We can go to the daily and I'll show you. But this was the inside day. We set the high there and the low here. This was, that was the low right there. There we go. So that was the low. That was the high. Surprisingly, what do you think? 7 in the morning. First 30 minutes, high and the low. That's what usually happens. The most volume is at the beginning of the day. Then it wanes off. Then it kind of spikes back up a little bit towards close. So that's why you want to do most of your trades here. You don't want to keep holding out throughout the whole day unless you're swinging. If you're swinging, you're looking at daily candles. You're not really in the mix of these candles. Cool. So you set your high, you set your low. This is the day that you're playing. And so what you would have did is big red candle on the 5-minute. You break down the 5-minute. If the candle is huge and it's aggressive, you're gonna have to break it down to the 1-minute or the 3-minute. Why? To get a better entry on the inside bar line. So if you do the 1-minute and you came here, you would see that right here it opened, came down, tested it, came up, came here. This is when you would have went in at 633. You would have taken a put. You would have set your stop loss at the fib levels. I'm going to show you guys. So you take the high and the low, the high of the day and the low for a put, and the low and the high for a call. And you would have played this, and you would have taken it at the, I think I messed this thing up, but whatever. I think I messed it up, but either way, you would have taken profit at the 0.5 here, which should have been here, but I think I messed it up. And then that's it. And your stop loss is right over here. So outside of that, I'm trying to think of what else I have to recap. So I have like a quick little, you want the break to have a good amount of volume. You'll be a lot more confident that way, but definitely take the trade. Stop loss is set, so you don't have to worry about that. And what else? You could just take a screenshot of this, so you can redo it to see the strike. And yeah, I was going fast because I was just recapping, so a lot of you guys know what it is. Is it better for the previous day candle to be much larger than the inside bar, or only slightly larger, or does it matter? Yeah, so ideally you want the mother bar, which is the previous candle, to be a lot bigger. If you're ranking inside bar setups, you usually want an inside bar that's a lot bigger because there's more compression. The analogy I gave was like a spring, if a little coil, right? So if a coil is like this and it's pretty big, and then you compress it the day after and it's like this, typically it's gonna have a better reaction to whichever side you let go of. So if your thumb and your index finger are here, whichever side you let go, it's gonna spring in that way, which is usually what we're trying to play, is that trigger breakout. So the bigger the candle before, the better the compression, usually the better the reaction. And usually the best setups for those are ones like these, which are called Holy Grail setups, where an outside bar, so it's usually a big bar with a lot of volume, is compressed into this little thing, and then you would have played the break on the downside. Does that make sense, Matty J? Hopefully it does. Cool. Yeah. So, any last questions? Any last questions? So, do you guys know how to trade inside bars now? For those of you who had no clue what it was, have I helped you? Give me some feedback. Was there something? Should I have talked slower? Should I have went over it more? Should I? I'm trying to look for improvements. You know, it's not mean. You're just be honest. Yeah, that's cool. All right, cool, cool. Great job. Thank you. Got to rewatch. May need to meet with you. Get a better picture. Yeah, again, I do one-on-ones. There's a good amount of people already in this live that I work with one-on-one frequently, and they've had big improvements. So cool. We'll run it back. Thank you guys. Hope you guys benefited from it. I'm gonna stop the recording.